analysis and iceberg analysis. So on the screen, I have a dashboard that has been, it's an anonymized version of some data that we've collected from a consumer products company. And our consumer products company is selling soft drinks globally in countries around the world. And what we're looking at here is the year-to-date sales variance by country, broken down into volume variance, price variance, and mix variance, ranked in order of size of the total variance, starting with the most negative variances. So we started with the bad news. And the biggest adverse variance that we can see is in North America, where we've got a very large price variance and also a mix variance, which is also unfavorable, and that's compensated for by a smaller favorable volume variance. Similarly, in the UK, we've got an adverse variance there, but that's driven largely by an adverse volume variance compensated for by favorable price and mix variances. So if we want to take this further and then investigate this data in more detail, what we can do is pick on the particular country that we want to look at. So say North America, for example. If I click on North America and then I go to the button here called Jump to Drivers, I can then look at a screen which helps me understand what is going on within the North America business. So I've transmitted from the previous panel the fact that I want to explore North America. And I can look firstly across the total brands of my business and look at the very simple relationship, that price times volume relationship driving gross sales. Comparing actuals against budget for the year to date to June, and I can see I've got a favorable volume variance but an unfavorable price variance, which has actually caused my gross sales to be below budget. But I can break those variances out further and actually quantify their financial effects through the bridge chart on the right hand side. So I can see I had a budget of about $2.29 billion for that period, that year-to-date period. My favorable volume variance has contributed about $0.05 billion of favorable outcome, but that has been more than destroyed by the unfavorable price variance and mix variance that I can see. So that brings me back to the actuals. And I can look, for example, at a trend. So if I pull up the trend chart, I can look at the trend of gross sales in North America. I can click, for example, on volume to see what are the volume trends, and that enables me to see that, you know, in the last quarter I've actually significantly beaten my budget, but I've got quite a stretch in the rest of the year to look at. I can also break this down by product, by brand. So I could look at Astro, which is one of my premier brands, and I can see this product's actually performing well. I've got a favorable volume variance and a favorable price variance, slightly unfavorable mix variance, but overall I'm doing better than I'd originally budgeted. So simple variance analysis there, which enables us to quantify the impact of volume, price and mix, and to do that at any level of the business. I can drill down into particular countries, for example, and then look across product cross sections. So I could drill into Astro into further detail. So you can see, that you can take this across huge data sets if you have that data available. So the second type of analysis I wanted to show is what we call the iceberg analysis, which is related because we're again enhancing the power of our variance analysis. So if I go back up to the top level of this business, across total markets and across all my brands, I can see that I've got an unfavorable variance of about $21 million for the year to date. And that's broken out by market on the right-hand side of the diagram. So that's saying that I've got unfavorable variances in Europe and Asia Pacific. If I then overlay what I call the iceberg, I can see that if I add up all of the variances at the very lowest level of this business, at the very lowest level that I collect the data, both by product or by SKU and by region or country or sales region within those countries, add all of those up, the actual variances underneath are much larger than the variances that appear at the top level. So adding up all my variances, I can see actually I've got 107 million of adverse variance across all the brands of this business. Which is, so for example, in Astro, although the variance that I see at the top level is only 3.5 million, actually beneath that, if I were to add up all the unfavorable variances, I've got 31.3 million, which is worth exploring. So I can do that again by drilling down. I can drill into Astro, and then I can then see that breakdown regionally, and I can see actually that in Europe there's a significant adverse variance that I hadn't picked up, 20 million, which is compensated for by a favorable variance in North America. Drilling down into Europe, I can then break that down by country and by brand. So big problems in the UK, take that further, drill down now into the brands within the UK, and I can take that as far as the data will let me go. So this idea of being able to spot variances that may be hidden by compensating favorable variances is quite powerful, used extensively by our consumer products clients. One final technique to show you is one which is much more forward-looking and which also incorporates data which is not financial in its origin. So what we're trying to do here is to use the wealth of data that we collect in our CRM system, typically Salesforce.com these days, to better understand the risk in our revenue forecast. So this technique applies to order book type businesses, companies that build to order, or professional services like consultancies that have to win business and then deliver it over a period of time and have a significant sales pipeline to manage. The power of this technique is enables us to incorporate both our financial revenue forecasts and actual results with a quantification of our sales pipeline and the risk around achieving our sales forecast. And I'm going to build this up step by step. The first thing is to start with a trend chart of our revenue, actual against budget for the year to date. This case study company has a December year end. We've collected our results to May. We've failed to achieve our budget for every month of the year to date so far. So what happens if we now overlay the forecast, our financial forecast for revenue that we have submitted to the group? Well, that forecast says we're going to have a couple of months where we're not going to hit budget, but then we're going to get back on budget for the rest of the year. So let's now overlay the secured work in our pipeline. So this is work that has been signed off by clients. We've got contracts in place. We know we're going to deliver it, and we've phased that delivery over that next 6 months. So that gives us a base for that forecast of secured work. And we've calculated in the table at the bottom there the secured coverage that we achieve. So the coverage of the secured work as a percentage of the forecast, the revenue forecast for each month. And we can see that in June, that actual secured coverage is 83%. It then drops to 66%, and then to much lower numbers in the remaining 5 months of the year. So let's then go back through our data and look historically at what the mean coverage has been for that 6 months looking forward view. And we can see historically we'd actually expect 82% of our sales forecast 1 month out to be covered by secured orders, 72% 2 months out, and so on. So we've overlaid those averages, and we can see they're actually, in all but June, those historic mean coverage numbers are actually higher than what we see in our current sales pipeline. So it looks like our sales forecast is going to be difficult to achieve. Let's now overlay our weighted pipeline from our CRM system, and we can see that takes us a little bit further towards achieving our forecast, but there's a significant gap of work to win that we need to close. So another way of looking at that is to draw a line chart, same data as before, and what we can do is overlay on that the actuals and the forecast there. We can overlay the secured orders implied revenue. So this is what we would expect to see in revenue from the orders that we have in place now, knowing that our historic mean coverage implies there's some work to win for the rest of the year. And then we can place a risk range around that. In this case, we've used one standard deviation above and below the mean to calculate a range of credible outcomes for for sales over that 6-month period. Comparing that against the Q2 sales forecast there, we can see that there's a big gap in September, October, and November. So a really powerful tool now for a dialogue with the sales function and with finance in order to agree a credible sales forecast. So, just to conclude, it's our experience in MetaPraxis that as data has grown in size and in volume, it actually presents a lot of opportunities to do further analysis and really answer the big questions about business performance. But it doesn't really imply the use of different techniques to ones that have been developed historically. It's actually just making best use of things like variance analysis and graphic techniques that help us think smarter, use statistical skill, and augment the power of the visual system in our brains to process that information effectively. So that's the conclusion of